CME Group is preparing to launch Bitcoin Volatility futures on June 1, 2026. These contracts will give traders a regulated tool to hedge against sharp Bitcoin price swings without needing to sell their spot holdings. The timing comes as Bitcoin trades near $76,797, and the Fear and Greed Index reads 25, indicating a market in defensive mode. With the broader crypto market cap at around $2.65 trillion, volatility remains a persistent risk for spot holders. This new product is part of a growing trend of institutional-grade tools entering the crypto space. Bitcoin's price can shift by thousands of dollars within hours, exposing long-term holders to significant drawdowns. Traditional methods of hedging, like selling assets, come with drawbacks. They lock in losses, eliminate upside potential, and trigger taxable events. Futures hedging provides an alternative. By opening a short futures position against a long spot Bitcoin position, traders can protect against downside risk without liquidating their holdings. The mechanism is straightforward. When Bitcoin drops, the futures contract gains value, offsetting the loss in the spot position. The goal is not to profit from the move, but to reduce exposure. This distinction is important in a market where volatility is. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The norm: CME Group announced on May 5 that the Bitcoin Volatility futures will settle to the CME CF Bitcoin Volatility Index. This index is a 30-day forward-looking implied volatility measure derived from real-time Bitcoin options order books and published every second from 7 a.m. to 4 p.m. Central Time. The index reflects market expectations of future volatility, which can be traded independently of Bitcoin's price direction. This is a key innovation. Traders can now hedge against volatility itself, not just price swings. The product is designed for institutions and sophisticated traders who need to manage risk in a market where large moves are common. The current Bitcoin price of around $76,797 makes this tool particularly relevant. At this level, many investors are holding large spot positions and seeking ways to manage downside risk without locking in losses. The new futures contracts provide a way to do that within a regulated framework. CME's move reflects a broader shift in the crypto market. Institutional adoption is accelerating, and with it, the demand for sophisticated risk management tools. Regulated futures markets have long been a staple of traditional finance, and their arrival in crypto marks a step toward mainstream legitimacy. The CME Group already operates a regulated crypto futures and options market, and the addition of volatility futures is a natural progression. Traders will need to understand how to use these contracts effectively. The contracts are not for directional bets on Bitcoin's price, but rather on how much the price might swing in the future. This is a nuanced distinction. A trader can be bullish on Bitcoin's long-term prospects while still hedging against volatility. This is particularly valuable in a market where sentiment can shift rapidly. The Fear and Greed Index currently sits at 25, suggesting that fear is. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Dominating greed among investors. In such an environment, hedging becomes a priority. The CME Group's new product offers a way to do so without sacrificing exposure to Bitcoin's upside. The next signal to watch is whether institutional adoption of these contracts increases after launch. If major funds and traders begin using the contracts actively, it could signal growing confidence in regulated crypto markets. This would be a positive development for Bitcoin's institutional profile and could help stabilize price swings. For now, the focus is on understanding how to use the contracts effectively and whether they will be adopted widely.